Welcome back to Vantage. We've been focusing on the halo theme, and geopolitics means that resources is a focus. Delighted to have Paul Gooden. Paul, could you introduce, first time on Vantage, maybe you could just introduce yourself, the fund you run, and then we'll get into the sector.
Sure, Neil, thank you for having me. So Paul Gooden, I'm co-portfolio manager of the Global Natural Resources Fund at 91 Asset Management. I've been investing in this space for about 15 years. And I used to work in the oil and gas industry.
Paul, you manage the 91 Global Natural Resources Fund along with George Heavley and David Hill. It's a $2 billion strategy. It's had a really good return over the last year, 53% over the last 12 months. For investors who haven't come across it, can you describe what the fund is trying to achieve and why you believe natural resources deserves a dedicated allocation in a sort of broader portfolio?
Sure. So the Global Natural Resources Fund aims to harness commodity price inflation through a portfolio of equities. So we invest across three main buckets: energy, metals and mining, and agriculture. And in terms of why a strategy like this deserves an allocation, it's really kind of driven by 5 pillars. So the first one is around electrification. So it's a big global mega trend. It's driving incremental demand for certain types of metals and incremental demand for power. Secondly, it's around inflation. So in periods of above trend inflation, few asset classes perform as well as natural resources equities. And the reason for that is the more you have sort of fiat currency chasing a fixed physical supply, so it kind of gets bid up. Thirdly, it's around valuation. So, our fund, the holdings typically have a free cash flow yield about double the broader global market. And that free cash flow is generally getting returned to you, the shareholder, via dividends and buybacks because the companies are very, very well disciplined. Fourthly, it's around kind of diversification. So this is a relatively undiversified strategy. Say that again. It's a relatively non-correlated strategy versus many of the other kind of strategies folks will be investing in. And then finally, it's about performance. So not just the outperformance of our fund versus our benchmark, which is MSCI Natural Resources, but also the outperformance of that benchmark versus the Bloomberg Commodities Index, which is the sort of highest profile index of the physical commodities. And there are various reasons I can get into about why that BCom index doesn't tend to perform so well.
Okay, so let's take a look at the performance, which is pretty strong over last year. Your December quarterly described 2025 as an exceptional year. So gold was up nearly 65%, silver up about 140%, copper hitting a record above $12,000 a ton. Looking at your portfolio, how much of this performance actually came from reading those moves correctly versus simply being exposed to the right parts of the market at the right time?
Yeah, so our process is really around giving ourselves 2 ways to win. So firstly, we want to sort of get the commodities directionally right on a sort of a 3, 6, 9 month view. But then we want something idiosyncratic in the company story that means that we can generate alpha even if we haven't got the commodity call right. And if I kind of break down last year's performance between those 2 buckets, it pretty much 50-50. I think in a more normal year, it would probably be more weighted towards the idiosyncratic company-specific factors. But yeah, we would try and get both right.
Okay. And one of the reasons I was very keen to have you in front of the Vantage cameras was what happened on the 28th of February, which is that, the US and Israel struck Iran. Geopolitics has sort of brought the sector into focus. Your January sort of commentary noted that you're deliberately underweight energy, worried about the sort of air pockets in oil price.
Yeah.
What changes have you made to the portfolio since that sort of event, the bombing, and how's the conflict sort of getting you to think about sort of commodity prices?
Sure. Yeah. So a lot of the performance last year was driven by being overweight precious and overweight copper. And that was exactly the right positioning for last year. And you're right, as we kind of entered this year, our base case was that the oil price would stay kind of relatively low into the midterm elections in November.
Yeah.
Now, one thing to remember is that the job of a physical commodity price is there just to balance a physical market. It's not anticipatory. And equities are more anticipatory. And our view was that post the midterm elections, for various reasons, the oil market would be tightening. And so even though we were kind of relatively cautious on the oil price, because we had that more positive view into 27 and 28, we were adding energy in January and February.
Yeah.
So by the time the conflict actually kicked off, we were slightly overweight energy. And as we sit today, we're kind of meaningfully overweight energy. So I would say the changes we've made in the fund year to date is we've kind of reduced the copper and the gold overweight, and we've added to energy and also to fertilizers, because just as oil and gas are impacted by this, a lot of fertilizer comes through from us as well.
Okay. So let's talk about the precious side. Gold was a big contributor to sort of last year's performance. It has performed, if you look over the course of 12 months, it's performed exceptionally strongly. It's come off of late. Again, some of this was supported by sort of dollar weakness, geopolitical uncertainty, but also the marginal cost effectively for the gold producers. They are producing sort of exceptional margins at this price. What's your view effectively in terms of your gold thesis? I think Barrick is one of your sort of top 5 holdings. Is this still compelling for you? And at what levels do you think that actually gold has really sort of reflected the scenarios that we're in today?
Sure. So, of course, bear in mind, we invest in gold miners rather than gold the commodity, just to make that clear. So look, on gold, I think a useful framework to think about is, firstly, what are the thematic drivers? And then what is the kind of positioning in gold? And so let's kind of take each in turn. So in terms of the thematic drivers, they're mostly still in place. And so what are they? They're firstly a weaker US dollar. And we think that we're in a dollar depreciating cycle for the next few years. So tick there. Secondly, it's about geopolitical risk. And clearly with what's going on in the world, geopolitical risk is still a problem, and who knows what is going to happen next. Thirdly, it's about kind of the fiscal environment, and governments around the world are still significantly outspending, which means government debt goes up. You see that in the US and the UK in particular. And the only way for governments to kind of get themselves out of that debt problem is to kind of run the economy hot. And then the fourth one, and this is where has impacted the gold price in the last couple of months, is on the monetary side, because there was a view that you would see monetary easing in the US with a new Fed chairman arriving in the next few months. And with this kind of energy shock, there's now a sort of a concern that maybe the Fed won't cut. So thematically, I would say certainly 3 of the drivers are still in place. And look, we'll see what happens with the Fed. I mean, given AI and potential job losses from AI, perhaps the Fed will look through any short-term kind of inflation issues. And then if you look at the kind of the positioning, if you look at a lot of gold is bought by central banks. And if you look at the sort of average central bank holding as a percentage of reserves, it's about 30%. And it's gone up, but it's about 30%. Back in the 80s, it was more than double that. So there's still room to go on the central bank buying side of things. And then if you look at the retail side of things, if you look at volumetric positioning in ETFs, it's still below where it was 3 or 4 years ago. So look, we are kind of structurally still bulls on gold, but kind of tactically, we are now underweight in the fund. And that's, partly because we look across the whole natural resources space and we see kind of better risk reward in other areas like energy and fertilizers.
Okay. You touched on AI in your last answer, and along with the geopolitical shock, you do have another big theme running in AI. And a big theme this year has been, this idea of, long-term returns. Let's find things that aren't impacted by AI. So, Halo, or heavy assets, low obsolescence, is a growing theme effectively. And we're seeing allocation being made to those kind of stocks. Clearly, this sort of plays into, the areas that you're sort of focusing on. It's a natural home for sort of capital looking for the halo trade. How do you think about it? Do you think this is a sort of lasting regime change, and how aggressively do you sort of make the investment case around that?
Yeah, so look, I mean, at the outset, I kind of outlined, the 5 pillars why this asset class deserves an allocation. And so, I could have mentioned as a sixth one, Halo, because, clearly, these are hard assets. AI is not going to disrupt, the hard physical assets, the producing oil wells and things like that. And in fact, if anything, the drive for AI is a tailwind because, AI is very power hungry. And a lot of that power is going to come from natural resources. So, look, I think it's helpful. In terms of how significant it's going to be. Look, don't know, but I think it's certainly helpful rather than hurtful.
Okay, and just a little follow on from that. I mean, it's not impacted valuations to the point that you think, oh, that looks very stretched. Because sometimes you see these sort of trends in the market, and you suddenly think that actually everyone is rushing into this sector at any price. You still think there's value in the sectors that you're looking at?
Yeah, very much so. I mean, I mentioned earlier that the sort of the free cash flow yield of our average holding is about double the broader market. So, valuations don't look stretched. And of course, ultimately, valuations are kind of driven by, or partly driven by, the commodity price.
Yeah.
And so a question we're asking ourselves is, what does the new normal look like post what's going on in Iran? And I think there are reasons to think that for some commodities, the mid-cycle price moves up, which helps the medium-term valuation as well.
Okay. The trends that you sort of focus on as sort of, mega trends, copper seems to sit right at the heart of many of these stories. It's something that's important for electrification. It's important for AI data build out. And now you've got potential supply disruption from the Middle East affecting sort of shipping routes. I think you added Lundin Mining to the portfolio in Q4, mainly for its copper exposure. You hold Glencore as a top position as well. How tight do you think the copper market really is? And how do you see that evolving over the sort of 12, 18 months?
Sure. So again, just to take a step back, the very strong performance last year was driven by this overweight in precious, and in the second half, particularly in copper. And look, we remain kind of structurally constructive on copper because the long-term volumetric demand drivers are clearly there for all to see. But we're actually underweight copper now. And the reason for that is the copper price moved up and copper actually is re-rated. But as we came into the year, the kind of apparent demand data from China was pretty weak. And China consumed a lot of the copper that's produced, and Chinese buyers are very kind of price sensitive. So we were seeing fairly negative apparent demand data out of China. And with what we're seeing now in the Middle East, that could potentially create more sort of demand problems for the copper market. So look, we liked it a lot in the second half of last year. Now it's an underweight, and more broadly, that is the big advantage of having a active strategy in this fund.
Yeah.
We're fundamental investors, so a lot of our work is bottom up, company specific work, but we do work a lot on the commodities as well. And so I was very pleased to see the team this year. We had our bets for last year. It worked very well, and in Q1 this year we've made some quite meaningful changes, which hopefully will pay dividends through the rest of the year.
Okay. One of the things that struck me when I was sort of reading your fund literature and the fact sheets is that you're pretty honest about things that work and things that don't, and you're pretty candid about actually the things that did detract from the portfolio last year. So zero weight in BHP. I think you had a sort of overweight in Shell that didn't necessarily sort of work out. So as a retail investor, what I think that what they would want to know is if a position goes against you or isn't working, how do you decide that that's a signal that the thesis is wrong or just noise that actually we just need to ride through? What's the thought process that goes through?
I mean, firstly, this is a personal view, okay? Philosophically, I think any good investor with experience should be humble. because you're going to get stuff wrong.
Yeah.
And I think particularly in this space where there's lots of volatility with the commodity, I think you've got to be humble, and that means that you listen and you learn. In terms of like when a position goes against you, we're kind of getting in there into sort of like the behavioral side of investing.
Yeah.
And I think kind of stage one of that is just recognizing that it's okay to get things wrong. You just need to get more right than you get wrong. You want your wins to be big and your losses to be small. So the first thing is like a behavioral acceptance that even the best investors get stuff wrong. So it's fine. Don't pretend to yourself it's not going against you. Accept the reality and approach it thereafter in a kind of a rational way. Once you've kind of reached that kind of nirvana of accepting that occasionally stuff's going to go wrong, what I think is quite useful is firstly, the cockroach theory, in terms of, is the problem that's caused the share price to go against you, is that a one-off?
Yeah.
Or is there potential more problems behind that?
Yeah.
And that's when kind of experience and domain expertise is very helpful. So often, if a project's getting delayed or going over budget, often that's only the first cut. There can be additional problems as well. So try and kind of look at the problem and say, look, is this the real problem in isolation, or is there a bigger problem? And then once you've done that, I think you just need to follow the maths. Ask yourself candidly, what is my kind of risk-weighted outcome here?
Yeah.
So yeah, try and be calm and be rational.
Okay. And we've talked a lot about the sort of positive drivers effectively for the sector. So energy, fertilizers, there's tightness in that market. I think there is a case for gold, higher inflation, weaker dollar contributing into the sector. It's always useful to think about the what could go wrong side of things. So what's the other side of it? If you had to articulate, the bear case for resources in 2026, what do you think about, and what does that look like?
Yeah, so this strategy performs well in periods of above trend inflation. I kind of mentioned that earlier as one of the pillars that kind of underpins this, an allocation to this space. The strategy also works pretty well in periods of stagflation.
Yeah.
Which, is something that people are increasingly concerned about. The environment it doesn't do so well in is if there's like an outright global recession.
Yeah.
Because what that tends to do is it impacts demand. The demand curve shifts to the left, and then commodity prices struggle and the equities struggle. So it's really that kind of, outright global recession, which is a scenario which would be problematic for the strategy.
Okay. Paul, that has been a fascinating run through a whole range of commodities and indeed sort of themes. We're going to look forward to sort of seeing how you perform over the course of the year. I do hope you come back for sitting in the Vantage seat maybe 6 months or 12 months down the line to report back on how the year's been. There's certainly no shortage of news flows. Good luck in managing the portfolio the months ahead. Thank you very much for being on Vantage.
Great, Neil. Thank you for having me.